Joining us is Elon Musk, Annex Wealth Management Chief Economist Brian Jacobsen. So, Brian, if you're singing from the same hymnal and you just heard Rick, I'm not saying that Rick is trying to downplay it. He's trying to put it in context. $2 trillion on 35 or whatever the number is less than 10%. So what do you is the market fine with this bill? Are they just shrugging it off? It does kind of seem that way lately.
Well, yeah, the market, remember, we have really come out of this period of zero interest rates. So to go up to 4 to 5% on the 10-year Treasury, that has been quite a big move. Now, longer term, where might we land here? It's possible, let's say the Fed gets down to 3.5% with their target rate. If you tack on about a 150 basis point term premium onto that, right, that puts you at about 5% for the 10-year Treasury. So in my mind, just given the uncertainty and the apparent lack of appetite for U.S. Treasuries when we get below 4%, I find it very difficult to believe that we're going to see a big move lower in rates, even if the Fed does begin resuming their rate cut cycle. Given some of the fissures that we're seeing in the growth numbers, I think that they would be justified in cutting rates this summer, not necessarily waiting until September, because so far it does feel like growth is beginning to slow faster than what inflation is beginning to reaccelerate.
If I wanted to put this a little bit differently, if I were, Senator Johnson, or he'd probably say, look, this is about my grandkids, not about the bond market this year. But if I were someone with concerns about the $2.5 trillion price tag of the bill or what have you, and I looked at the bond market this year, what would you say its message is right now? Is it, if anything, yields to me right now seem to be following developments on the econ and inflation front, which have been pretty dovish, and that seems to be it, really.
Well, and maybe that's really the way that it should be, because if you think about these projections, they're looking out 10 years and they are going to be wrong. Are they going to be wrong to the upside or to the downside? And so I think that really the market is more focused on not just the here and now, what's going on with growth and inflation, but then what's sort of a more reasonable expectation about the effects of these, right? We know that $2.4 trillion number, that's just multiplied by whatever it is this year by 10, right? So divide that by 10, that's the annual effect. The tariffs, when the CBO scored that, I was thinking, well, Trump isn't going to be president 10 years from now. And so why are they assuming that these tariffs are going to stay in place for that period of time? So there's a lot that goes into some of those projections where I think the market can look at it and say, it's kind of like an IMF or an OECD forecast where they're talking about what's going on now. It's like, well, tell me something I didn't know.
So, Brian, how much longer can we see stocks basically continue to move higher? S&P is 3% from the all-time highs, while bond yields are drifting lower, but appearing to do so on a little bit weaker economic data. Can that divergence hold?
I actually do believe it can, because if we look at what was in the beige book, talking about the radical uncertainty that we have, uncertainty leading to hesitancy, leading to a slowdown. But the market already has priced that in, right? So the market is going to lead the economy, and that uncertainty will eventually resolve. I think we're going to get a little bit more clarity, let's say by Monday, when those briefs are filed by the plaintiffs in terms of whether or not we're actually going to get a stay on the tariffs, or as we get closer to the July 4th deadline for the passage of the one big beautiful bill. This uncertainty, I think the market is actually just kind of looking through it a little bit and saying we're going to get some clarity. Businesses are going to adjust. Corporate America is proved itself again and again at being very adept in adjusting to changing circumstances. And we're likely going to experience some resumed economic growth, if not during the summertime, but perhaps at the latest by the fourth quarter here. And that's what the market, I think, is really looking forward to. Not the here and now, but about what's coming down the road.